The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the GoldMoney Foundation podcast with Dominic Frisby, keeping you up to date with expert opinion on precious metals and the markets.
Hello and welcome to the GoldMoney Foundation podcast, hosted in association with Frisby's Bulls and Bears. I'm Dominic Frisby. It's October the 11th. I'm sitting in the Sloane Square Hotel in glamorous southwest London, and sitting opposite me is a man who comes to London at this time of year, normally on Alfa Romeo related projects. I'm sitting opposite Bob Hoye. Hiya, Bob.
Dominic, good to be here.
Now, for those of you that don't know Bob Hoye, he's formerly a geologist, he is a financial historian, and he's now the chief strategist for institutional advisors. And his calls on the market have been excellent over the years, and particularly this year, if I may say, he had a momentum peak forecaster that called the highs in the markets at the beginning of the year, and he's been monitoring the falls as they happen very, very accurately. So, Bob, well, congratulations on that call.
Thanks a lot, Dominic. That one, by the way, clicked in January of this year. And when it clicks in, it says that when you get a speculative move going, that it will continue straight up, but it'll stop within 2 or 3 months. So then that was our target. We had the big surge that would end probably around April. And, of course, everything was surging together, stocks, corporate bonds, commodities, and most of them sort of made highs late April, early May. That part of that forecast also was when we backdated it back to the high in commodities in 1973. It gave the signal, again, with 2 months of the top. And then later on, the National Bureau of Economic Research came along and said, well, that recession just started in November of 73, which was when the forecaster gave the signal. Then moving ahead to, of course, the great big mania in gold and silver that blew up in January 1980. That thing gave the signal in November, and then 2 months later it goes crazy and blows out. But then along came the old NBER, and they determined that the recession started in that January, at the peak of speculation. So then when our signal came in January, you knew somewhere out there, March or April, it would peak out, and somewhere that would be the start of the next recession. And as the rest of this year has rolled on, with some severe shocks to the marketplace, it looks like the recession probably started in May. And that would be a global recession, because everybody was playing all the same games.
Absolutely. Now, like I say, it's early October. What happens next? I want to get stinking rich by Christmas. How do I go about doing that?
That's always dangerous by any time. The big hit, of course, there was almost a panic in August with various revelations of insolvencies in the European basket case, Greek, those sort of problems. You had debt instruments soaring to 100% and things like that. So that, we wondered at the time, when it was pretty heavy market in August, we thought we'd get a relief rally into first half of September, and then you would look for some seasonal problems, and yeah, it came in. But then you had, going into the end of September, the corporate bond prices made new lows. You had the spreads, credit spreads, widening to new wides. You had a number of important stock exchanges, Asia and Europe, making new lows. And you had commodities, CRB, making new lows. Now, what was not making new lows was the stock market. New York Stock Exchange, senior indexes there, they kept bouncing off the lows of August a number of times. So the other one is, we use the old gold-silver ratio as an indicator. And when it's going up, chances are there's going to be some problems. And it was heading up, and then it stopped going up. And it stopped going up each time the Dow or the S&P stopped going down. So they were working together. So this is where we thought maybe October is not going to be the month of a disaster, such as when you have a troubled market after a speculative peak in the spring. Sometimes the fall can be really bad. So I think that the August and September hits got a lot of bad news into the marketplace, and then probably through to work towards Christmas now, choppy, sideways, disappointing. 1 week, central bankers are heroes and got everything fixed. Another week, they're a bunch of dogs and they haven't got anything fixed. But I don't see any technical stuff that would say, hey, this is going to get ugly. Notwithstanding that, there still is that we are in a post-bubble contraction, and they're awful. And what's more, there's nothing any policymaker can do about them in the long run.
Very interesting. I mean, looking at the S&P, for example, it seems to have found a bottom in that kind of 1080 to 1100 area, and every time it goes and retests it, it finds support there. And then, but at the same time, it's kind of capped at around, from memory, around about 1200.
Yep, that's the one we look at, and that was the support level.
I mean, it's a kind of swing trader's delight, really, at the moment, isn't it?
Some of it was pretty choppy when you had, well, that was quite a while ago, 4% down days followed by 4% up days. And then you also had the Lowry stuff, which I read the other day on their upside buying pressures and downside selling pressures, that they've had some 90% up and down days that are unprecedented. And they got 78 years of history. So we are in remarkable times.
Would you be hoarding cash now, or would you be putting some money to work? I mean, or would you just kind of stay on the sidelines and stay safe?
Well, let's put it this way. When I was planning to come to London and have a good time, I covered all my shorts and trading positions. And essentially, there were some good dips recently added to some of my favorite junior stocks. So I'm not very aggressive at the moment.
Okay, let's talk about junior stocks. I was looking at a chart that shows the ratio of gold to the CDNX, which is the composite of the TSX and the venture, and that is at 2008 lows.
Oh, yes. The whole sector, the senior golds and the junior sectors, by that valuation, are very cheap. There's a reason for it, and many people think that some of it is due to the fact that you have so many alternatives, like ETF instruments. Sure, there's a lot of trading money going into there, but also there's ETFs for copper and base metals too. And base metal stocks, until the top earlier in the year, were doing brilliantly and were probably overvalued. And I think that's going to be one of the major conditioners on this whole curiosity about gold stocks being so cheap relative to the metal, is because when you're on a business expansion, as we have been since the crash ended in 2009, base metal prices outperform precious metals. And therefore you get base metal stocks outperforming precious metal stocks. And then when you go into the again, I think we're in this next recession, the real price of gold relative to commodities such as crude oil, which represents energy prices, has been going up since earlier in the year. It's gone from 300 to 500. It's a huge increase in relative prices for gold. So this is a built-in bonus for the gold mining sector. But the problem is the senior golds and the junior golds are subject to what's going on in the big stock exchange. And when everything's going down, so do the gold stocks. So what we look for now is perhaps, somewhere in the next year, there'd be a lot of the problems would be over, and you get a good stock rally, which would include a brilliant stock rally for the gold sector, because you got this built-in cushion of having had a very good advance in the real price.
A bit like we had between August and December last year.
That would be the model, yeah. So what we're looking at here on the big picture for long-term investors, a couple of years from now, it's probable that all the orthodox stocks would be very much lower, with some big swings in between. And then all of the gold sector would be very much higher, with some big swings in between. So you can buy the dips on this one.
Okay. I mean, one of the dreams that's been touted, or one of the selling points, is kind of home stake in the 1930s, gold stocks flourish in a post-bubble contraction. And there are times when it looks like it's going to happen, and then it never quite does.
Yeah. Well, we know that, for example, if you could have bought Homestake in the first part of 1930, right through 1930, at around $9 a share. Then it started to move up as the real price of gold moved up, because the gold price in U.S. dollars was $20.67, and it didn't change. So by the time you got to the end of 1932, there was still, this was before Roosevelt started fooling around, and the stock was up something like 130%, and their earnings were up something like 130% with no change in the price of gold. This is what makes us look at the real price of gold more frequently. So there was good innings for that. Eventually, the Homestake stock got up to over $65 and was paying $4.50 a share dividend each year. And if you were buying it in 1930, that was a $9 price. So that's an outstanding return.
Yeah. One of the things that people never mention when they discuss the how Homestake flourished in the 1930s is the fact that you weren't allowed to own gold after 1932, but you were allowed to own Homestake.
That's true, but also in Canada, you could own gold, and there was Dome Mines, and that then became one of the leading producers in Canada, and its stock, because it would be more orphaned in the crash than Homestake, but the Dome Mines outperformed Homestake. And again, it was probably U.S. buyers too, but the Canadian market was very vibrant. Gold is a global item. The real price is also global, and the companies making money in those days paid out in dividends. This is where it's interesting this time around that some of the senior gold companies are really focusing on getting some dividend out to the shareholders.
I think they're absolutely right to do that. My kind of personal frustration with the juniors, many of them, I'm not going to mention any names, is that so many CEOs promise we're going to have this and that by next year, we're going to have production, we're going to have this, and there's always, some reason, and it never happens. And you just think, if you've got a resource, build a mine, start mining the gold, and forget all the other stuff.
Well, it takes some money, it takes some pushing the story to the public to be able to raise money. But of course, at any discovery, you have to raise money until it becomes a mine, in which case you shouldn't have to raise any money. But this is where, in the old Vancouver Stock Exchange, which I've grown up in, as I like to say, everything I need to know about the financial markets I learned on the old and vicious Vancouver Stock Exchange. But the exploration is my side of the game, and I love it. But one also learns over the decades that when you have a great drilling rush going, good results, consistent results, a good general market, then the stock goes to the moon. And at some point in there, the public says, this is going to be a mine. Now that's when you get out. Because typically, a discovery play will peak out with lots of excitement. The new mining analysts to the deal will, of course, have discounted present values on it, and they'll be pretty close to what the stock is trading then. But then you have to go through the whole boring business of putting a mine into production. Typically, the decline is to 1/3 or 1/4 of the exploration high. That's not off by a quarter, but down to 1/4. So if you have a $4 stock on exploration, you might have a $1 stock going into production. Then you had a whole new set of shareholders coming in that will be risking their money and hoping for a good startup. Then you got other shareholders who say, let's get a couple of quarters of production. Those are calendar quarters of production in, and see how it does there. So this is why I prefer exploration stocks, because they are a lot of fun. And if you're in a decent market for them and you get some good results, it's very, very profitable.
With this kind of bull market in gold, which began in 2001, we've seen a lot of companies that made discoveries in the early part of the decade, and a lot of those companies' stocks peaked maybe in May 2006, around about then, with that kind of high. And then they've been relative dogs ever since. But these are the companies that are now at a late stage of development and will actually in the next year or three start actually producing some gold. So they're through the cycle that you've just described. Are we going to suddenly find an abundance of gold coming to the market?
Oh yeah, you will. But the thing is that when you're in a post-bubble deflation, there's a huge investment demand for gold. So don't ever think that the onset of expansion of supply is going to drive price down. No, because the investment demand will be there year after year. Typically, a post-bubble contraction will run for about 20 years. And for us, the real price started to go up when the bubble ended in 2007. And so we're only that many years.
Was 2008 1929 or was 2000 1929?
Well, let's say that 2007 and 2008 were a combination of 1929.
But I meant was 2000 the dot-com?
No, 2007 was a rare item. It was all on the dot-com innovation. It was an amazing market, but there were elements missing that would have then said it was a 1929 market. One was you needed to have good speculation going on in real estate. Nothing in 2000. You need to have a pretty good market for commodities. Wasn't happening. Remember the guys on...
Yeah, I mean, that was, okay.
You said, Lawrence Kudlow was saying all through 2000, right up to the top of 2000, you just had to buy stocks because there was no inflation. And then going into 2000, you had commodities going up, base metals going up, and Larry was saying, you just had to buy stocks because there is inflation. He never ever changed, But at any rate, the other signpost on the beginning of a Great Depression is, of course, the mania in tangible and financial assets, which we had in 2007. Then you had the classic change in the yield curve to steepening from being inverted. You had a classic reversal in credit spreads to widening. And then when the bear market did start for stocks in October 07, the recession would have been expected to start right away. And it did. It started in December. Now, throughout most of business history, in normal times, the stock market has a high, and 10, 12 months later, the business cycle has a high. And say, for example, 2000, the stock market high was in March 2000, and then a couple of years later, NBER came in and said officially the recession started in March 2001, 12 months later. So then the NBER determined that the recession started in 2007. So that fit the old model where the recession starts virtually with the bear market.
So we're in 1932. We're not in, or 1931 or something.
37 or something like that.
Oh, I was going to say, well, that was my question. Are we in 1937 or are we in 1931 at the moment?
We're at the end of the first business expansion. We consider it started, the recession started in May. So that sort of looks like 1937, which was the first business expansion coming out of the crash. It also, the recession started virtually with that bear market.
But hadn't gold stocks already peaked by then?
Let me see now.
36, 37 was kind of...
Oh, yeah, no, the peak was, in the mid-30s. Well, 33 is when Roosevelt started fooling around with the price of gold. But all he did was reinforce the rise in the real price, which drives gold shares in a depression. So it peaked. You had a long peak in there. Maybe the high for Homestake was 65 or 66. But it was a sort of high from 35, 36, 37. And then you went into World War II, and that then changed things quite a bit. You didn't have a great gold rush at the bottom of the Depression. There's a number of tools to say that depression ended in 1946, and then the long expansion started. So it was one of the few depression bottoms where you had a high price of gold, real, but everybody, unemployment didn't exist because there was a total war going on. Whereas, for example, the Depression bottom in 1895, you've had a high unemployment, a very high real price of gold, so people go finding gold. So you had the great discoveries in 1895, Klondike, Australia. 1840s was the Depression bottom, and you had gold, the big discoveries in California. So it works somewhat like a clock, but you still have to trade within the moves you expect. And we stay on our theme that it's going to take a long time to fix this credit problem. It's a natural process. Eventually, the credit revulsion takes everybody up to the point where we're not going to, companies and municipalities and states say we're not going to borrow any more money. And individuals and fund managers say, well, we're not going to lend any money. And even the guys in between, the underwriters, say, no, we're not doing it anymore.
Well, the private markets are kind of saying that at the moment because despite, such low interest rates, people just aren't borrowing and banks are tightening lending. But the whole thing seems to be being prolonged by all this deficit spending and government bailouts and all the other things that we're seeing.
Well, they've made some fantastic efforts on it, but keep in mind that you had a two-year bull market that peaked out in 1937 where the S&P did a double in, 105 months. And this time around, you had a two-year bull market that virtually doubled in the same number of months. So the governments are adding instability. They're not fixing. And the serious money is kind of hiding. And also market with investment demand increasing the real price of gold. So this is where we who understand and participate in the mining side would be changing hats and going from being base metal miners to being potential gold miners.
Do you see national currencies potentially collapsing in all of this?
I don't see. Lesser countries will. I think the European community will come apart as an official organization. Perhaps the Deutschmark might be go back to being the euro currency. A lot of the gold bugs consider that the Federal Reserve and its activities, and combined with the U.S. Treasury, is an evil. I agree. But their idea is that the markets are going to trash the U.S. dollar and the U.S. economy, a repudiation, if you will. But I don't think the markets will repudiate the U.S. dollar because it is still the senior currency. The markets will repudiate the idiots who have been thinking they've been running it. I mean, these guys, they go and take a PhD in currency manipulation and foreign exchange manipulation and interest rate manipulation, and they think they're geniuses. But all they've done is add to the violence out there.
Do you think the US dollar's kind of been to just above 70? It's tested it a couple of times in the last 3 years and it's found some support there. It's just had a nice rally from about 72 to about 79 on the US dollar index. Are we in a new bull market for the US dollar?
Yes. That one's in a pattern that my colleague Ross Clark has had for the last few years, and it's working its way down, 1, 2, 3s and oversolds, but it's in a pattern where an extensive bull market for the U.S. dollar is possible. It became overbought a few weeks ago at above the 79, and that's one of the other things that could help the markets go choppy for the next few months, is that the U.S. dollar did become overbought on the last period of nervousness. So here again, the standard gold bug thinking is, to their mind, the worst thing in the world that could possibly happen is the whole collapse of the U.S. dollar. And that they've not been dissuaded from that view by the collapse in 2008, where everything went down the tubes and the U.S. dollar went up. So our view is that it's been 100 years of coaching by interventionist economists that the best of all answers for any problem, or if you want to keep things going, is to weaken the U.S. dollar. So in that mind, a weak U.S. dollar is the best thing that can possibly happen. Well, going the other way, the worst thing that can happen is an outbreak of sound money. But then if everybody's short the U.S. dollar, there's a high probability on each of the periods of crisis, the U.S. dollar will go up. And it's working recently.
Do you think the gold price will ever go to a level whereby the U.S. could pay off all its debt with its gold in Fort Knox?
No, because I don't think that arithmetic will ever be reached. You want to go back to...
Happened in 1980.
It may have, but that was a numbers game. But then the serious move was in 1860s when they went off of gold, and that was to prosecute the Civil War. And then at the top of that bubble in 1873, the leading newspaper in New York editorialized that nothing could go wrong with the stock market because the treasury system was existing. They didn't have a central bank. What's more, they didn't have a central bank that was on a gold standard, i.e. Bank of England. So then that left the Treasury Secretary, who was admired then, with an absolutely free hand to create credit to prevent things going wrong. Well, the 1873 bubble was a massive failure, and it went wrong. It really went wrong. So that by 1884, senior economist in England looked around and said, oh, this is a Great Depression. So that was the first official nomination that I've seen of calling it a Great Depression. It lasted until 1895. But to get back to the gold side of it, the serious side of this New York street became bothered by the violence that was in the wake of this being on a fiat currency. So I forget when it was, maybe 1875. The president then wrote a letter to the Treasury saying at such and such a date, I recall it could have been 1878, the U.S. will meet all demands. So then they had gold points at New York and New Orleans and Philadelphia. And of course, there was concerns going into this point where greenbacks would be redeemed in gold. And they were worried that there was not enough gold in the Treasury. Things were going to go all to hell. But on the first few days of having it on, where the Treasury would sell gold at a point and buy gold at a point, more gold came in because it was more useful to use a gold-backed note system.
Bob Hoye, thank you very much. And if you want to follow Bob's work, you can do so at institutionaladvisors.com. That's institutionaladvisors.com.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.